Hi guys, welcome back. We are starting with price elasticity of demand and total revenue, which means the link between total revenue and PED and how PED is could influence, the total revenue after price adjustments. Now, just like always, I'm going to be showing a past paper question. It's from November 2019, paper 22. It says explain how knowledge of PED for a good can help businesses to assess the impact of price changes upon their revenue. क्या कह रहे हैं पीडी की नॉलेज यानी पीडी के बारे में इंफॉर्मेशन किस तरीके से किसी भी बिजनेस को इस बारे में असेस करवाएगी यानी हाउ कैन दे फिगर आउट what impact would price changes or price adjustments would have upon their revenue. And just like at the start of the video I said that PED, your price elasticity of demand, has an impact on the business's total revenues after price changes, right? So price change होने की वजह से what would be the impact on total revenue is dependent upon, whether your demand is elastic or inelastic, right? Now, first we need to obviously understand what revenue is. And by the way, for this question as well, like I always say, the first thing is assessment objective one. So you will have to define what total revenue is, right? Just a bit of definition and formula would be enough. Now, total revenue is basically the amount of money a firm is receiving by selling something. So if I'm selling something, and whatever money that I'm receiving is revenue. Now, revenue is not profit. Once you get revenue, you deduct all the expenses from it, and that is basically your profit. So revenue does not equals profit. Right, total revenue is calculated by the formula price times quantity. So let's say if I'm selling a cup of coffee for $5 each and I'm selling 100 cups, so my revenue would be $500. This is basically my revenue, right? And on the diagram, I would represent this if my price is $5 and my quantity is, let's say, 500, then this rectangle A is basically my revenue. This entire region represented by the rectangle A is my revenue, right? This is my revenue basically. Right, guys? So this is how it's represented on the demand curve, right? So it's basically a total income that is generated before you have accounted for any of your production costs, utility expenses, and all of that. And once you account that, you'll end up with profits. Now, exam में ये सब तो नहीं लिखना होगा because I'm explaining the topic right now, so I've written this. Otherwise, the formula and the definition and which area represents on the demand curve revenue, this would be enough. Also, instead of shading the areas like usually students do, it looks untidy. They do not shade it in the proper way. Firstly, and so it's better that you just represent it through A, B, and C. Anyways, so like I said that, revenue is influenced by at what price you are selling it and how many goods you are selling, how many units you are selling. And the fact that at what price you sell, that price has an impact on the number of units that you will sell because ultimately consumers are sensitive to prices, right? So if you change the price, the consumer behavior and response would change accordingly. And the law of demand taught us that if the price goes up, the quantity demanded has to go down. But how sensitive would consumer response be depends upon elasticity, and that would actually have an impact on your total revenue, on the size of your total revenues, right? And for this reason, आप लिख कर आएगा, you write in the exam that for this reason that firms are, also interested to know about their PD because PD has an impact on revenues, right? Whether the revenues would go up or down after prices going up or down, changing, depends upon the price elasticity of demand. And for this reason, firms are also interested. So if you mention this in the first paragraph, that's something good, right? So first, let's see what would be the impact of price changes on total revenues if the demand is elastic, right? So if the demand is elastic, guys, so let's say, okay, what will happen if you increase the price of a product? Now, if the demand is elastic, right, an increase in the price, now all of this is basically analysis. If the demand is elastic, an increase in price causes the revenue to fall, while a decrease in price causes the revenue to rise. Now, the first two lines is just simply asserting something without really explaining it. So this is just mentioning it without explaining it. You have to explain it in analysis. So what it says is that, what I've written is that if the demand is elastic, if the price goes up, the revenues will fall, right? While if the price goes down, the revenues will rise, right? And if we have to see why this would happen, so for example, if the demand is elastic, right, and you increase the price, so the reason that you will write is that an increase in price results in a proportionately larger decrease in quantity demanded, right? So now we know that if the demand is elastic, a small rise in price could bring about large or drastic changes in quantity demanded, such as because the consumer would be highly sensitive and the quantity demanded would fall proportionately larger than the change in price. So if the price is going up slightly, but the quantity demanded might fall proportionately large, or there would be significant reduction in quantity demanded. And it's the significant reduction in quantity demanded. Now, hear me out very carefully, students. Is the significant reduction in quantity demanded, or in other words, the proportionately large reduction in quantity demanded that contributes to the decline in overall revenue. See, if I'm selling a cup of coffee for, let's say, $5, right? And the next day I talk to my team and I say that, you know what, I'm going to be selling my coffee for now $7. I increase the price per coffee by $2. So this means that for every cup of coffee that I sell, I get $2 more, which means that my revenue should go up by $2 for every cup of coffee I'm selling. And that, while that's true, but that means that for every cup of coffee I sell, my revenues go up by $2, and that is 100% correct. But whether my overall, now hear this out, whether my overall total revenues would rise or fall depends upon how many cups of coffee I am selling. While it's true that for every cup of coffee my revenues go up by $2, but if I end up selling significantly smaller amount of coffees than before, my revenues would in total decline. And that is exactly what we need to see. And that is exactly what we need to write. And that is exactly what you should be. I mean, this is what your concept revolves around, right? So if the demand is elastic and PED is greater than 1, an increase in price results in a proportionately larger decrease in quantity demanded. Now, you see, to be very honest, being an examiner, I'm telling you the examiners are looking for these lines. They are looking and searching that whether you have written it or not. These are your key lines and you must underline them. And because of this proportionate large decrease in quantity demanded, that is what contributes to the fall in your total revenues. So for example, if the price increases by 10%, quantity demanded will fall by more than 10%, right? Just like I told you, if the price of coffee goes up by, let's say, $2, then my quantity demanded there would be a significant reduction in my quantity demanded, right? So quantity demanded would so यहाँ पे हमारी in our example, if the price is going up by 10%, the quantity demanded is falling by more than 10%, right? And this decrease in quantity has a bigger impact on total revenue than the increase in price. Now, what this means is, what this line means is that although I increase the price by, let's say, 10%, or in other words, if I bring the coffee example, I increase the price by $2, and increasing the price should actually increase the revenue. But it should increase the revenue by per unit, because you see, what is revenue? Revenue is basically price per unit. This is per unit price, selling price per unit multiplied by how many units you're selling. That is the quantity you are selling. So, so although my revenue per unit is going up by $2, it is actually this that will determine the final impact on my total revenue. So if my revenue is going up by, let's say, if my revenue per unit is going up by $2, right? But then if my quantity sold is drastically falling by a large extent, then you can see how the fall in quantity demanded would offset the impact of an increase in price per unit. And the impact of an increase in price per unit is that yes, your revenues per cup of coffee would go up by $2, and that's true. Well, that is true, but this is also true that my overall revenues will fall because this is going down significantly. So although my revenues per dollar might go up, but then the fact that quantity sold would decline significantly will offset that effect. And as a result, it would bring my overall revenues down. And yes, whatever I'm saying right now is all analysis that you need to mention, okay? And what I've then written is that if there is a price decrease, but on the other hand, if there's a price decrease, if the price goes down, right, it would result in a larger than proportionate increase in quantity demanded, which will bring your total revenues up, which will increase your total revenues. So for example, if you were selling your coffee at $5 per unit, right, and you see you were selling 100 coffees a day, so your revenues were $500 a day, but the next day you say that I'm going to be selling my coffee at $3, and everyone's in my coffee shop is like, what are you going to are you crazy, are you selling your coffee by $3 now? You lose out so much. And I'm like, no, I'll gain. And they're confused because they haven't studied this concept. And they're like, for every cup of coffee you sell, you will now earn $2 less. But I tell them, while that's true, but the number of coffees that I will sell would offset that effect. And so what we witnessed that day in the coffee shop is that we were able to sell, our coffee sales was let's say 200 units this time. We doubled our coffee sales, and I mean in terms of sales volume, in terms of number of units sold, and we can see that our overall revenues are now 600, right? So this is the concept that we're actually studying, and so that and ye concept, right? And the question is asking us that how can this knowledge, see, I am a coffee owner, right? And I knew that this would happen. I knew that if I decrease the price, my revenues would go up. And the reason I knew was I knew that my demand is elastic. So decreasing the price went in my favor. And that is what the question is asking, that explain how the knowledge of the PED for a good can help businesses assess the impact. I had assessed it that day, that if I decrease my price the next day, my sales would go up, right, upon their total revenues. That is exactly what the question is asking us. And that is why I've written yahin pe, the reason why I wrote this line, total revenue is impacted. Total revenue is influenced by what prices the firm is charging and how much quantity is it selling. And since PED has a direct impact on the quantity a business sells for whatever price it charges, it is for this reason that the firms are also interested to know about their PED, so that they can know that they can assess the impact. Ab economics mein, you know that for everything we have to prove things through a diagram. Diagrammatic analysis should corroborate economic theory, right? And so now let's see. I have also made a diagram here, right? Although you won't be really required to show the numerical values, but this is just for your understanding that I'm doing that. In the exam, just show by just show it by the areas. So let's say that my coffee is being sold at P1 is represented. You have a demand curve, which is an elastic demand curve. Make sure that the slope is flat. Don't try to make an elastic demand curve by a steep slope. Make it a flat slope, a shallow slope. So if my price is $4 and I'm at $4, how much am I selling? I'm selling 11 units. So my revenue at P1 should be $44. Total revenue at P1 is $44. And if I increase the price to, let's say, $5, my coffee is now going to be sold the next day at $5. The next day I witnessed that my quantity demanded and has gone down to 8, and so I lose overall revenue by $4, right? And so my total revenue falls by $4. And the reason is that although for every coffee I'm selling, I'm gaining $1 more this time because I'm selling my coffee at $5, so I'm selling it at a $1 higher price. So for every unit that I'm selling, I'm getting $1 more. But since I am selling, the number of units that I'm selling is significantly less than before, that is offsetting, right? So the increase in price might cause some increase in revenue, but the increase in price might cause some increase in revenue, but the decrease in quantity demanded for coffees is proportionately larger than the increase in price, which sort of brings the overall revenues down. And that is why I witnessed that the next day my revenues are actually going down by $4. अब एग्जाम में you don't need to numerically prove this, आप सिर्फ areas दिखाएंगे. And so what you see is that what is your old revenue, since you this 4 times 11, this bigger rectangle, I have represented this a plus b. अब एग्जाम में बच्चे क्या करते हैं, which is not wrong, but the presentation matters. जो टॉप स्टूडेंट्स होते हैं ना, ए स्टार स्टूडेंट्स जो होते हैं, और दो स्टूडेंट्स हु एंड अप विद डिस्टिंक्शंस, और द टॉप स्टूडेंट्स who leave no risk, no margin for any sort of risk, right? They always come up with the best way to write answers. And a better way is that you, instead of shading, because shading looks untidy, na? Right? Also, don't like shade it like this because your papers are scanned with a pencil. I mean, don't do it like this with a pencil, your papers are scanned. Do not make the diagrams with a pen as well, make it with a pencil, a dark pencil. So you say A plus B. So the old revenue is area A plus area B. So area A plus area B is your old revenue. And once you increase the price to $5, your revenue would be price times quantity. And so this entire rectangle A plus C is your revenue. Initially, your revenue was how much? Initially, your revenue was A plus B. This was your revenue A plus B, right? But now you're selling, now your current revenue is C, A plus C. So A is common in both, right? A was initially part of your old revenue as well, and now it's also part of your new revenue as well. So technically, what we learn is that you're gaining C and you're losing B, right? So you're gaining C and you're losing B. And the revenue that you're gaining this much is smaller than the revenue that you're actually losing, right? That is area B. And that's actually why your overall revenues are falling. So the revenue gained is rectangle C, while the revenue that is lost is rectangle B, right? And so it follows and that if the demand is elastic and if you increase the price, the quantity demanded will fall proportionately more, causing your overall revenues to go down. And I've written this as well, that at the initial price and quantity, the sum of the rectangles A plus B is your revenue. So basically, when the price is going up, your revenue, so primarily the reason why your total revenue is falling is overall total revenue, although you're gaining area C, right? Although you're gaining area C, but then you're also losing area B, and the area that you have lost is larger than the area that you have gained. And now you can ask me, how do we know that the area that we have lost is larger? I mean, you can see that for yourself. The diagram itself is visually telling you that area B is larger than area C. So exam may make sure that your diagrams are neat, and so a good strategy would be that you're explaining this in the paragraph. You're explaining this in the paragraph, but once you make the diagram, so for the clarity and the convenience of the person who's checking your paper, because you are the one who's giving the exam and you are the one who's being tested. So for the convenience of the examiner, you can write on the side of the diagram that revenue gained rectangle C, revenue lost rectangle B, right? So immediately before even reading what you have written here, the examiner would be like, oh, you know what? This guy knows what he is actually, he knows what areas are showing what. And now let's read what he's written, right? And so guys, on the contrary, what we see is that if your demand is elastic and if the producer and the firm decreases the price, your total revenues would go up and the business would witness increase in total revenues. Now, don't use the word sales here, okay, students, because sales is a business word. So, right, economics, we use total revenue. So don't say sales. So basically, so when your demand is elastic, a decrease in price would cause total revenues to increase, and the reason is because the increase in quantity demanded, as you can see, the price is going down. The increase in quantity demanded from Q1 to Q2, this increase in quantity demanded is more than the decrease in price, and and so what happens is that since I said the increase in quantity demanded, it basically more than offsets the decrease in price, and that is why your total revenues basically go up, because the reason is that if you decrease the price per unit price, then your per unit revenues would go down. For every additional unit that you sell, you will get less revenue. But since you're selling, since you end up selling a significantly more or a proportionately more amount than the percentage decrease in price, right? What happens is that your overall revenues go up. So, for instance, let's say any luxury car dealer, because luxury car dealer would have an elastic demand. If a luxury car dealer, he drops the price, he would definitely witness an increase in revenue, right? And total revenues would go up because the number of cars sold would definitely go up. The quantity demanded would tremendously would proportion the increase in quantity demanded would be proportionately higher than the fall in price, and that would cause your overall revenues to go up. That would reflect the luxury car buyers' sensitivity to price changes. And we know that when demand is elastic, buyers are sensitive to price changes, right? And so when the price goes down, the quantity demanded rises proportionately or relatively more. And since the increase in quantity demanded is relatively more than the fall in price, so even if revenues go down, right, per unit, and that if you're saying that revenues go down per unit, and let's say for the sake of agreeing, we agree that yes, that could have an impact on your revenues, on your total revenue, but then the increase in quantity demanded would outweigh and offset that fall in price. So overall revenues would go up, right? So it's just like the same example I gave you, that I was selling my coffee the next day at $3 instead of $5, but then I was selling more coffee, right? So although yes, I was getting $2 less for every coffee that I was selling, but the increase in the number of coffees that I was selling was so significantly larger that it totally offset and outweighed the fall in the decrease in revenue due to the fall in price. And we can see on the diagram as well कि वही the gain in revenue क्या दिखा, I mean the old revenue was A plus B. This was your old revenue at a price of P1. But then the new revenue at a price of P2 is B plus C, and so area B is common in both the cases. So revenue is going down by area A, while revenue is going down revenue is going up by area C, and we can clearly see visually that area C is bigger than area A, which means that increase in revenue is more than the decrease in revenue area A. Right? So total revenue is rising because the gain in revenue, write this down. I mean, this is what you need to write, that a gain in revenue offsets and outweighs the fall in revenue, right? Simply because it's the quantity demanded that rises proportionately greater than the price fall. And hence what we concluded, what it follows is that a fall in price is in the best interest of the firm when demand is price elastic. Now guys, if we see what will happen if the demand is inelastic and see how a change in price would result into changes in revenues, whether it would rise or fall, and ultimately whether revenues would rise or fall depends upon the extent of the proportionate change in quantity demanded relative to the changes in price. And so when demand is inelastic, an increase in price would cause an increase in total revenue, while a decrease in price would cause a fall in total revenue. That's correct, because you see, if the demand is inelastic, demand reflects consumers' willing. If you look at it intuitively, if you try to come up with the economic intuition, demand reflects consumers' willingness to pay. And obviously, when the demand is inelastic, consumers are willing to pay a high amount, right? So even if you increase the price, quantity demanded would go down, but relatively low or relatively less or proportionately less. And so economically, if you look at it with economic intuition, you can prove this as well. And so obviously your revenues would go up, right? For example, so let's say, these pharmaceutical companies, right? Medicines are essential, and essential medicines have an inelastic demand. So if the pharmaceutical companies, they increase the price, they raise the price, there would be a drop in quantity demanded, but relatively less, quite less, which will potentially increase their revenues. That is exactly what we are seeing. That if the price, if the PED is less than 1, an increase in price causes a proportionately or relatively or comparatively smaller decline in quantity demanded. Right? Let's say if the price goes up by 10%, the quantity demanded will go down. It will fall. If the price goes up by 10%, the quantity demanded will fall by less than 10%. Right? And since the quantity demanded would fall by less as compared to the increase in price, your overall revenues would rise, right? And if the price falls, on the other hand, if you reduce the price, that's something bad for the producer if the demand is inelastic. Because if the price falls, a percentage price decrease, if the price falls, right, then, that would result into a percentage price decrease gives rise to a smaller percentage increase in quantity demanded. So if you think that if you reduce the price, that would cause some large increase in quantity demanded, you're wrong, because your demand is price inelastic. Your consumers are price insensitive. The consumer behavior is insensitive to price change. So even if you reduce the price, all those quantity demanded would rise, but relatively less. You won't end up having a much larger increase in quantity demanded, and your overall revenues would rise. Sorry, your overall revenues would fall in this case. In both the cases, what I've written is, in both cases, the effect on total revenue of the change in price is larger than the effect of the change in quantity. What this means is that since the change in quantity is not that much, whether you increase the price or decrease the price, it is actually the change in price and whatever its effect is on revenue that actually brings about, that determines the final increase or decrease in total revenues. What I mean to say is that, for instance, let's say if I say that I am selling if we look at the coffee example, let's say if I was selling the coffee at $5 and I am selling 100 units, so I was making $500 a day by selling 100 coffees at $5. And the next day I end up reducing the price to $3 with the assumption that probably my coffee sales would go up. The number of coffee demanded would go up, and that would cause an increase in coffee sales. But I witness only that my coffee sales went up by 10%, right? And if you sort of calculate the percentage, you can sort of calculate the percentage change in price. That's how much 2 over 5 times 100 should sort of give you 40%. So my price is going down by 40%. This 5 to 3 is representing a 40% decline in price. But my quantity demanded is only going up by 110. So I'm selling only 10 more coffee, 10 more cups of coffee the next day, right? So my overall revenues are $330 only. So my overall revenues are falling from 500 to, it fell to 330. And the reason behind this is, the reason why this happened was that now I am selling every coffee that I sell, I'm selling at $3, which means that for every coffee I'm getting $2 less. I'm getting $2 less for every coffee. For every coffee that I'm selling, I'm getting $2 less. But I hope that I'll end up selling a lot more coffees. But I only ended up selling 110 coffees. I mean, I did end up selling more coffees, but the proportionate increase in the quantity demanded for coffees the next day was less than the decrease in price, and that brought my overall revenues to go down. So although I did end up selling more coffees, but only by 10%, right? And the increase, and so the fact that I am selling more coffees, that factor would contribute to some increase in revenue. I did end up selling more coffees, so that would contribute to some increase in revenue. But the fact that price was going down by a relatively larger percentage, that offset the effect of some increase in revenue, and that actually brought my overall revenues to go down, the effect of the price. Because quantity demanded is not really playing a big role here. Because quantity demanded is not really neither going up or down, and it's just going up or down insignificantly. And because of that proportionately small decline or increase in quantity demanded, it doesn't really much have a role to play in my overall revenues, whether it will go up or down. It's the price effect that is, has the main role to play here. In both the cases, that is why I've written, in both the cases, the effect on total revenue of the change in price is larger than the effect of a change in revenue. The reason why my overall revenues went down was because the price had gone down by 40%, from $5 to $3 per coffee. And so although I did end up selling coffees more the next day, but only 10%. And so you see how that price effect is offsetting the fact that, although I did end up selling a bit more coffees, but the decline in price was relatively larger than the increase in the number of coffees that I was selling. and so that brought my overall revenues down. And if I can show that on this diagram as well, and so for instance, sorry, on this diagram, in fact, that if my price is going down, right? If my price is going down, my overall revenue is A plus B, right? And if I decrease the coffee from P1 to P2, I reduce the price, my quantity demanded for coffee goes up from Q1 to Q2, but you can see that this is a significantly smaller increase in quantity demanded, while this decline in price is a significantly larger or relatively larger decline in price. And since revenue is basically price times quantity, so price and quantity both have a role to play on the overall revenue. And since over here quantity demanded is behaving insignificantly, it is actually the direction of the price that determines whether my revenues will go up or down. And if the price is going down, the total revenues are going down. So the revenue lost is area A, because A plus B was the initial revenue. This was the initial rectangle. Initial rectangle was area A plus B, but now my revenues are B plus C. So I'm losing A while I'm gaining C. B was common in both, but the gain in revenue is quite less. Visually you can see as well, C is such a small area while loss is A, so overall revenues will fall. And so it is not in the best interest of the producer. इस तरीके से you need to write so this is the economic expression of an initial. It is not in the best interest of the producer to reduce the price if the demand is inelastic, right? Because obviously, I mean, and so, but also do mention the fact that bring the economic intuition into play as well, that demand, if the demand is inelastic, it reflects higher willingness to pay, and the producers would obviously capitalize on that by increasing prices. And we can see from this diagram that if the producer increases prices from $5 to $7, right, the quantity demanded goes down from 14 to 12, but that's okay. We can still see numerically as well that the old revenue is $70 or the new revenue is going up by $14. Although the quantity demanded is going down, and the fact that quantity demanded is going down, it did contribute to decline in revenue. We can see that revenues are going down by area B. But since I said that revenue is price times quantity, so price and quantity both have an impact to play on revenue. And since consumer quantity demanded is really insensitive to quantity demanded is playing an insignificant role here, because consumers are insensitive to price changes. That is why whatever happens to quantity demanded, whether it goes up or down, really wouldn't really have an impact in determining whether your final revenues would go up or down. And it's actually the price that will determine your final revenues will go up or down. It's actually the price over here. The price is going up, so your revenues are going up, because the percentage increase in price is proportionately more than the percentage decline in quantity. So your price is actually bringing your overall revenues up. So this area C, that is your gain in revenue, is offsetting and outweighing the decrease in revenue. And that is exactly what I've written, that with the price increase, total revenue gain, that is rectangle C, is larger than the total revenue loss, that is rectangle B. Therefore, total revenue increases, right? So obviously it is not. So it is in the best interest of the producer that if they want to have more revenues, if they want their revenues to go up, they should increase the price if the demand is inelastic. Right? So, and the simple reason is that an increase in price would increase total revenue because the decrease in quantity demanded is proportionately smaller. Ye line to you have to write in the exam. Now guys, let's see what will happen to total revenue if the demand is unitary elastic and price changes. Now we are already aware that if the demand equals to 1, that is unitary elastic demand, the percentage change in quantity demanded would exactly equal the percentage change in price, and hence the PED would be equal to 1. And because of that, then if this is so, then it means that a price change will have no effect on revenue. So the previous revenue and the new revenue after the price change would be exactly the same. And I also mentioned this under unitary elastic demand as well when I taught you that the total revenue and total because revenue is for the producers, while it is the same revenue, the value of the revenue equals the value of the expenditure for the consumer. It is expenditure for the consumer, right? So the revenue for the producer and the expenditure for the consumer stays the same after a price change. And the simple reason is that when demand is unitary elastic, the changes in the prices, the reason why they do not affect total revenue is because the proportional change in quantity, it just offsets the change in price. There's an equal proportionate change in quantity demanded, and because of that proportional change in quantity demanded, that offsets the change in price. So the decline in, so if let's say that your price is going up, let's say your price is going up from P1 to P2. So if your the increase in revenues because of the price, because of the effect of the price on revenue, that is your revenues would go up, would be exactly offset by the proportional decline in quantity demanded, that would bring your revenues down, right? So the gain in revenue, that is rectangle C, is exactly matched by the loss in revenue of rectangle B, which leaves total revenues for the producer unchanged, right? Because the quantity demanded is basically, it changes by exactly the same percentage, or which simply means that there is a proportionate, equal proportionate change. There's an equal proportionate change in quantity demanded following a change in price. Right, guys, that is why. Now, one last thing before I end the video, I want to talk to you guys about is that I already discussed with you that elasticity along a linear downward sloping demand curve varies, where price elasticity, where the PED is infinite, at the point where the demand curve the demand curve touches the price intercept or the y intercept, or it touches the y-axis, and it equals to 0 where the demand curve touches the quantity axis at the x-intercept. And I also, guys, in the previous videos, I mathematically proved that. Why is it so? Why is it infinity at this point, and why is it equal to 0 at this point? And what we learned in that video is that as we go down the demand curve, let's say it's infinity over here at the y-intercept, and as we go down the demand curve, we studied that PED falls, right? The PED starts falling. So it's more elastic at this point on this part, and it's less elastic in this part, right? Remember? Less elastic in this part. So we studied that, and at the midpoint of the demand curve, it is equal to 1, it is unitary elastic. And as you go down further, it becomes inelastic, and it becomes perfectly inelastic at the point where the demand curve on your x-axis, basically on your x-intercept, where the demand curve touches the x-axis, that is your x-intercept, right? Where the demand curve is intercepting the x-axis, basically. Now, so basically along a linear downward sloping demand curve, the elasticity would vary, which means that if elasticity varies, then it would have different effects on total revenue if the price decreases or increases. And let's say that we are saying that if we say that the price is decreasing, and let's calculate the effect of what will happen if the price decreases following a downward linear sloping demand curve. So if the price is going down, we know that the demand is going up. If the price is going down, the demand is going up. That's the law of demand. But don't think that it will have the same effect on revenues throughout the demand curve. The impact on revenues along a linear downward sloping demand curve following a change in price would depend upon at what range you are operating at. If you're operating at the elastic range and the price goes down, then your revenues would go up, because we've already studied the rule. जब डिमांड कर्व आपका ओवरऑल डिमांड कर्व आपका इलास्टिक होता है, ये हम पढ़ के आ रहे हैं अभी कि if your demand is elastic, we already studied right now a few minutes before that if the demand is elastic and if you reduce the price, your revenues would go up if the PED is greater than 1. And if the PED is less than 1 and you reduce the price, your total revenues would go down if your PED is less than 1, right? And so if let's say you keep on decreasing the price, your revenues would behave differently because your elasticity is different along a linear downward sloping demand curve. So if you're operating at the elastic range of the demand curve, in the upper portion of the demand curve, we studied that the upper portion of the demand curve is elastic. And if you reduce the price in this range, your total revenues would go up following this rule that if the price goes down, total revenue goes up if your demand is elastic. But since along a linear downward sloping demand curve, the elasticity varies, so in the elastic range, if you reduce the price, your total revenues would go up. And so the diagram that is below the above diagram, the second diagram, is basically your total revenue diagram, and I've plotted total revenue against quantity demanded. So So as you are decreasing the prices and your quantity demanded is going up, your total revenue is going up, right? Because it's increasing because your demand is elastic, and if the demand is elastic and you reduce the price, your revenue should go up, and your revenues reaches its maximum at the point where PED is equals to 1, because beyond this point, iske baad, beyond this point, beyond the midpoint of the demand curve, beyond the point where you're beyond the midpoint of the demand curve, which means that once you reach the midpoint and the point where PED equals to 1, उसके बाद जो range है demand curve की, that is the inelastic range of the demand curve, this range of the demand curve, it's inelastic till the horizontal axis, till the x-intercept, which जहाँ पे demand curve becomes perfectly inelastic. And we also proved it mathematically कि why. Now, if you reduce the price in this range, and if the demand is inelastic in this range, then although quantity demanded would be going up, but we just proved that if the price is going down and your demand is basically inelastic, and if you reduce the price, your total revenue goes down. And the simple reason why total revenue goes down if the price goes down following if your demand is inelastic is because if you reduce the price, consumers are just insensitive to price changes. So even if you reduce the price, it attracts consumers, but not that much. So although quantity demanded rises, but relatively less. So your overall revenues do not increase. In fact, they decrease, because a decrease in price, the effect of the price on the revenue is offsetting the effect of the small increase in quantity on revenue. So although your revenues might slightly go up because of the increase in quantity demanded, but that isn't that much, and the overall decrease in revenue because of a fall in price is offsetting and outweighing that, bringing your overall total revenues down. And that is why we are seeing that after in the inelastic range of the demand curve, if you're decreasing the price, we see that your total revenues are going down. And so your total revenue is maximum. This point, guys, listen, when you're drawing this diagram, if you're drawing this diagram in the exam, then this point should correspond with this point. I mean, at the point, this point पे आपकी PED equal to 1 होगी, उस point पे your total revenue is maximized, right? At that quantity. This is, let's say, Q. This is Q, right? So what we are saying is, and if you reduce the price in inelastic, your total revenue goes down, right? So total revenues are maximized at the midpoint of the demand curve, and a decrease in the price in the upper half of the demand curve, increases revenues, but decreases the revenues in the lower half of the demand curve, in the inelastic range of the demand curve. So that's it, guys. I hope you understood the video and enjoyed it. I'll see you all in the next video. Until then, take care.